Have you ever wondered how much debt the countries around the world are carrying? As per the Institute of International Finance report, global debt has already hit a record of $307 trillion dollars in 2023. So, what will be the effect of this huge pile of debt on you and me? Are we again moving towards another economic collapse? To understand what's in store for us in the future, we're diving into the complex world of global debt, exploring who owes what and what it means for economies worldwide. First, let me tell you about the impacts of huge debts. The impacts of global debt are profound. High debt levels can stimulate economic growth as it can fuel growth through investment. At the same time, it also poses risks. Risks such as excessive debt can stifle long term prosperity. For example, if a nation's debt increases, significant portion of national budgets goes towards servicing debt, reducing funds for crucial public services. High debt burdens can strain social programs and welfare systems, affecting quality of life for citizens. Debt crises like those seen in Greece can ripple through global markets, impacting investor confidence and economic stability. Sri Lanka also faced similar situations in the year 2022. External debts, mainly from China, crippled the economy. The pandemic worsened the situation. Today, major economies are also ridden with high debt. United States holds a colossal $34 trillion dollars in debt, but Japan has the highest debt to GDP ratio. As you all know, debt to GDP ratio, an economic metric that compares a country's government debt to its GDP. It is pivotal for evaluating economic stability and repayment ability. Japan is having 264% debt to GDP. World today has three categories of debts: government debt, corporate debt, and household debt. When nations borrows to fund infrastructure, social programs and manage deficits, it is known as government debt. But when companies borrow for expansion and operations, it is known as corporate debts. North America and Europe dominate here, with tech giants and manufacturing sectors driving high borrowing. Bloomberg reports that EU and UK tech firms raised 30.5 billion euros from debt in 2023. Apple Incorporations, for example, is having long-term debt of $104.59 billion dollars. In fiscal 2023, Apple generated $114 billion dollars in operating income. This means that Apple has approximately 92% of debt to operating income ratio. Similarly, household debts are those when individuals borrow for housing, education, and consumption. Countries like Australia and Canada lead in household debt levels. In the fourth quarter of 2023, household debt in Australia increased to 109.70% of GDP. According to the OECD, the average household debt is 211% of net disposable income, which means that Australians owe twice as much as they earn. While in emerging markets, debt burdens are growing fast. India, for example, at the end of March 2024, India's external debt was $663.8 billion. India's external debt, which has previously been as low as $96.4 billion in September 2000. The external debt to GDP ratio is 18.7% at end March 2024, which can be considered as low compared to other economies. Looking ahead, several trends and projections shape the global debt landscape. When low-income countries get into excessive debt burden, recession is triggered with high inflation. This chokes the spending in essential sectors like health, education, and social safety nets. On the other hand, as per World Economic Forum, more than 80% of the 2023 debt buildup has come from the developed world, with the US, Japan, the UK, and France registering the largest increases. Among emerging markets, the biggest rises came from China, India, and Brazil. As a conclusion, it can be said that balancing growth with fiscal prudence is crucial for long-term economic stability. Understanding global debt is crucial for navigating the complexities of our interconnected world. So, what are your thoughts on this topic? Share them in the comments below and stay tuned for more insights on global economics. Don't forget to like, share, and subscribe for more content like this.